If you are tuning in now or joining us here in the room at Politico's Competitive Europe Week, my name is Catherine Carlson and I'm a finance reporter here with the Brussels team in Politico. So let's have a think about the context for our discussion on banking union today. So we're at the beginning of a new mandate. Legislative work is picking up again. We're defining the new priorities for the EU going forward for the next 5 years. We have a new Financial Services Commissioner coming in. There's a new Econ Committee, a new European Parliament. And it's also a big political moment internationally. We've got US elections coming in a matter of weeks. We have a new UK government. We have multiple European elections this year with some surprising results. Now, specifically the banking union project, it's progressed in fits and starts over the last few years. So in the last mandate, we had provisional agreements on the CMDI package. We should have trilogues coming at some point during this mandate. EDIS has been revived, at least in the Parliament, although it still seems to be on ice in the Council. And other elements of the banking union, like the ESM reform, still seem to be on ice. At least Basel's done and dusted, or is it? Our new Commissioner-designate for Financial Services, Maria-Louise Albuquerque, in her mission letter from Ursula von der Leyen, she's tasked with building the European Savings and Investment Union, which will include banking and capital markets, revive the securitization industry to free up bank financing, find a way forward on EDIS, and focus on shadow banking, as well as improving the supervisory system at EU level. So if we think about what all of these themes are bringing together, much of it is about further integration to deepen the pools of capital that the EU can draw on to fund its political objectives. But politically, this has proved to be a stumbling block time and time again, whether because of resistance to consolidation, home host issues, or different crisis management rules. Before we get started, a brief reminder to talk about us on X or the social media of your choice with the hashtag Politico Competitive Week. But now let me introduce our speakers on stage. To my left, I have José Manuel Camper, the chairperson of the European Banking Authority, and Jo Swingedouw, head of prudential policy and financial stability at the National Bank of Belgium. So thank you both for joining me today.
Thank you.
And I'd like to get started with kind of a big picture question on where we are in terms of banking union. So as we're heading into the new mandate, we've heard so much about competitiveness. I think we've all heard the word competitiveness until we can be, deaf. At the same time, the entire project of the banking union is a financial stability project. It's born out of the financial crisis. Do you think that these two goals, competitiveness and financial stability, can they go together or are they naturally in conflict?
First of all, thank you very much for inviting us to be here. It's a pleasure to be. And I clearly don't think they're in conflict. I would certainly think for sure that we will not be competitive, whatever that means, or we will not have competitiveness if we have financial instability. So I tend to think that financial stability is a necessary condition for our economy to develop in a relatively proper way. So in that sense, they're clearly not mutually exclusive. They're complementary, very, very much so. I think that we have built a system that has increased our resilience of our banking sector. The last 4 or 5 years has clearly shown that, and that's good news. I do think also that, and in your initial remarks, you pointed out very well, that we have a banking union that's still not complete, and more important, that a single market for banking services that we're not exploiting to its full potential. And to me, that's, when I think about the European Banking Authority, that's our core of what we should try to pursue going forward. It's like there's all this debate about competitiveness in Europe and being able to develop all the potential of our single market. Well, I read that into my own mandate. I need to develop the potential of the banking sector in the European Union, which still has a lot to go.
You, same question.
Yes, I tend to agree with José Manuel, and thanks for having me on this panel as well. It is clearly not a contradiction. You need to have financial stability as a precondition to build a proper and genuine banking union and capital markets union. And in that respect, I would indeed compliment to say that it's not all gloomy. I think everyone is in agreement that important steps have been taken. The first pillar, the SSM, is working effectively. The second pillar has made significant progress also in terms of on the regulatory side to make the project more comprehensive. And we see it in the field, as José Manuel said, the banking sector is in a much better shape. NPLs has gone down dramatically, especially, for example, in the southern part of Europe. That is a success also of the banking union. It's unfinished. We need to fix the rest of the story, but it's the glass is at least half full.
But it does seem to be that there are divisive issues inherent here. And we were hearing on my colleague Gregorio's financial services panel earlier today about the FRTB delay and whether or not this is justified for competitiveness sake, if it's a risk to financial stability, if Europe is in a different position in implementation to the US. I'm calling to mind Claudia Buch's appearance in the Econ Committee a few weeks ago, where she said that she personally didn't think the FRTB delay was necessary. So, I mean, do you have thoughts on where we are with Basel and what the global situation is looking like? What are your expectations there?
Yeah, on that side, I would be cautious. I think the package as it has been agreed in Europe is not necessarily completely in line with international standards. So I would very much argue against lowering the standard further. Of course, there is the issue of competitiveness, and I think it was the right decision to delay for 1 year, but that should not be a signal for further delays. I would say on the contrary.
Do you think that there's a risk of further delays?
Yes, I see the issue of competitiveness, of equal treatment with other countries. But let's not go for the lowest common denominator in that respect. We have seen the proposals in the UK and in the US. The US will come with new proposals after the consultation. The debate was quite aggressive, but I would be cautious. What we see or what we know for the time being, and as said, we do not know the details of the final proposals that will be put forward, or at least the impact of it, but it's not necessarily less strict than in Europe. It's not necessarily less strict. The problem in the US is the problem of the scope. And I think they're making mistakes in that respect. That was what the proper assessment after the banking crisis of March 2023. So I would argue stick to the plan, of course, looking around what's happening, but so far in the US and in the UK, at least that's our assessment, and it's not a complete picture, I agree. It is not necessarily less strict than in Europe. As said, the US has other problems, and that should be looked at.
But presumably this is also contingent on the outcome of the US election in a few weeks. I mean, is that a concern for you?
Yes, that's not in our hands. I'm not so sure that it will be completely depending on the outcome of the US election. Of course, politics play its role, that's clear, but the agencies in the US have quite some autonomy. So let's see how it goes. And of course, we should adapt if things would go into the other direction in the US, but I would be very reluctant to go for the lowest common denominator. That's not in the interest of Europe. That's not in the interest of the European banking sector. That is not in the interest of the supervisory framework in Europe in terms of credibility for the European banking sector going forward.
José Manuel, the EBA is the authority picking up all the pieces and dealing with the mountains of secondary legislation here. So what are your thoughts on the timeline for FRTB and the global situation with Basel?
If I may, I'll come back to the FRTB issue, but more broadly on the Basel package. The Basel package is much more broader than the FRTB. It has many other components, and overall it's a good package. It's a package that's putting us better at managing the risk of the banking sector, so we should be confident on implementing that package as we have planned it, as hopefully as loyal as possible to Basel. And as already Joe said, there are certain areas which we at the EBA have highlighted that they're not consistent with the Basel agreement, but we should implement that swiftly. And let me remind you that this came out of the financial crisis in 2008, was negotiated in 2017. We'll implement it starting next year and fully in 2030. By the time I will be retired from the EBA. So this is not fast. So from our perspective, the sooner the better. You know? Now, having said that, FRTB, we're postponing for a year. Well, within that context, 2008 to 2030, a year is not the end of the world. And it's a particular area, it's market risk in which global global rules for global markets are very important, much more than, for instance, in mortgage markets or in other areas which are not such a global competition. So it's okay that we postpone it and we try to align with our major jurisdictions in which there are also banks that do the same activities. So that's fine. It makes our life at the ABA a bit more complicated. We have to publish, we have published a roadmap, we have to adjust that, we publish a no action letter that certain parts of the legislation will not apply, but we'll work through that. That's our job.
And what are your thoughts on splitting FRTB off from the rest of the package? I mean, does this make it more complicated, or is it a logical thing to do? Claudia Buch wasn't a fan.
No, I mean, as I said, we have to redraft a little bit of our work plan during the summer after the Commission's decision. It makes it a bit more complicated, but it's certainly doable. And as I said before, the thing that's important for me is to signal clarity on the fact that we're going forward with the implementation of the package. Mm-hmm.
So let's think about some of the big ideas that we've seen discussed as we're going through this moment of institutional change in Brussels. We've obviously had the letter, Draghi reports. These have come up a lot today in discussions. Some of those big picture ideas that came out from those reports, more consolidation in industry, potentially a single supervisor. Yo, would you like to react to some of those big picture ideas and what you might think could work?
Yeah. I think everyone is in agreement that something needs to be done in order to increase global competitiveness of Europe. So that is a new narrative. I think we should carefully look at that. But we should not forget financial stability, by the way. In terms of consolidation, yes, I think we need more cross-border consolidation, as we need probably also more domestic consolidation, at least in some countries. Cross-border consolidation or consolidation will increase, will facilitate diversification, will avoid sovereign biases. So there are clearly advantages, but there are also risks, and these risks need to be managed. So what I would, and what we see today is that in quite a lot of countries in Europe, still, the banking sector is dominated by local banking sector. We see not a lot of cross-border activities, and we see also that cross-border activities are tendency to decrease. We see that for foreign presence in jurisdictions is 10 to 20%, which is extremely low. That could not be, I think, the idea. That is not where we should be. So I think there is quite a lot of work to do. And what we see also that is currently ongoing in the market is a debate, I would say, before we enter the debate on the banking union, that should be part of the acquis européen, which is part of that you take participations in other banks across Europe. So I think for the new term, we should reflect on that to see what can be done, but it should not be in a selective way. The banking union is composed of different packages. It is the issue of the sovereign risks. There is EDIS that is lagging. On crisis management, I think a lot of progress has been made also more recently, and then there's the cross-border dimension. If there is a comprehensive package to bring forward all these ideas, I would say at the same pace, with the same ambition, then I think that should be done not in a selective way, but in a comprehensive way, moving forward.
José Manuel, do we need more consolidation?
In banks? Yes, but before I address that, let me address a bit broader. When you talk about the big ideas, the big idea that has come forward is that we need more capital markets, more savings and investment in market, and that's clearly something that I personally strongly support. I think that's something that's clearly complementary. I like to say that when Brexit came about, we lost one member country union, but we lost a big chunk of our financial sector, and particularly of the capital market sector, and that's something that we need to recover in Europe, at least, and be aware of that. So that's something that we should support. I think it would be really good for banks. It would be an excellent complement for banks and excellent manner to enhance our single market. Within the banking sector, do we need more consolidation? I mean, Joe highlighted already many of those topics. We've been arguing for a long time that the banking sector is sclerotic. I don't need consolidation for the sake of consolidation. I need better banks. I need bad banks to exit, good banks to gain market share, and consolidation that ends up being in better markets. As part of a European institution and responsible for having a single market in banking services, I like to see cross-border banking because that's a strong signal to me that the single market is working. And we have built a single rule book, we have built single supervision, we have a strong resolution framework, particularly for larger banks, but we don't see a lot of cross-border activity increasing. And that's the part that for me would be the materialization that all this construction that we built is working for us. It's providing risk diversification. So do I like to see consolidation? I like to see better banks. And I like to see good banks winning.
There's been a lot of talk today in the earlier sessions about the Commerzbank Unicredit situation. I mean, do you have any specific comments on these? I know that as supervisors, you're limited in what you can say, but if you have any broader thoughts.
No, it's what I said in my earlier intervention, and I will not comment on individual cases, but what is happening in some cases should be the normal way of doing business in Europe and should not be perceived as problematic. And as said, we see in several countries where the participation of foreign shareholdership in the banking industry is extremely limited. As said, that cannot be the end goal.
Any thoughts?
No, as I said before, I mean, for me, it's, if there really is a transaction that's going to take place, I don't know if there will be or not. It needs to put forward, whoever the buyer needs to put forward their project, needs to be assessed by shareholders for sure, by supervisors, by authorities, see if it's a good project, a better project, and if it is, let it succeed.
So one of the other big ideas in the Draghi report is about boosting securitization. This is obviously a big factor in the bank financing related part of boosting capital markets. From a supervisory perspective, I mean, do you think boosting the EU's securitization market is feasible? Do you think it poses more risks?
It is. I think there is a lot of pressure to do something on that side. So let's see. The Commission will come up with proposals and a consultation next month. So let's see what is in. I think we should look at it in a comprehensive way. There is the issue of the due diligence, transparency, the investor side, and then there is the let's say the prudential side, the features, how it is structured, what can be done to facilitate it. I would nevertheless argue to be cautious on the prudential side. It should be evidence-based, risk-based, evidence-based, and not deviating us from Basel. But let's see. I think things can be done in order to facilitate the structuring, to make this market functioning more smoother. But let's also take the time to reflect very well. We have done a lot of work in different European fora on these proposals in the past. Now it seems to be that they are not working as we expected. So let's think before we react. So it's a good idea that consultation will be launched, that we will see what are the ideas, that industry and supervisors community can react on these proposals. But I would say do not forget stability out of the picture.
Is more securitization a good thing?
Yeah, I would say overall yes. I mean, I share everything. I don't want to repeat what Joe said because I share many of his thoughts. But as a simple conclusion, yes, we should have an active securitization market. Why not as part of the capital markets? It's a legitimate way for banks, particular banks, but not only, but for banks to generate a better ability to manage their balance sheet and their loan portfolio and to pass on some of those assets to other parts of the financial sector. Why not? We should try to make sure that that exists. Again, coming back to my idea, we should continue to push on the idea of having securitization that is not just a bunch of country portfolios that are being securitized, but a European securitization would be really ideal.
So while we're on the topic of legislation that might be coming down from the next Commission, obviously this is all tentative, but we have seen work on NBFIs in this mandate. So this is also known as shadow banking, non-bank financing. We've seen the macroprudential review from the Commission. There seem to be signs that there could be something coming on macro-pru, on NBFIs. Do you think that more work in this area is needed? I mean, what would be your hopes here?
Yes. On the other hand, I see in the Draghi report that regulation is part of the problem. So I think we should be cautious. First of all, I would like to stress that we have still a lot to digest from the previous round. There was an enormous avalanche of regulation. Banking package, Solvency II, ESG, AI Act, AML, you name it, you have it. Dora, Mika, and like a lot of these legislative proposals are not yet fully implemented. So I think we need some time to digest. Having said that, if there are new issues that emerge in order to make, let's say, the market more stable, of course, that should be looked at. But I would nevertheless argue for some, let's say, reluctance on an all new avalanche of new initiatives. Having said that, NBFI is clearly also on the international table a very topical issue. There are risks because the banking sector seems to be rather safe, so we should look also to these other sectors. But I think there is in the current narrative some reluctancy to make sure that we're not in contradiction with that new narrative of global competitiveness. So yes, for financial stability, yes, to make sure that new risks are addressed, but be reluctant to launch new initiatives that would make life and from industry and for supervisors more complicated going forward.
Yeah, it's an interesting point that you raise about the global conversation, because I think a lot of the discussion that we see about the risks of NBFI is happening at the level of global standard setters, but we're not necessarily seeing so much of it trickle down into block-specific legislation. So, I mean, is this conversation all talk and no trousers? Do you think something will come?
Well, it's interesting that you seem to be begging for more regulation.
I need something to write about. Come on.
No, I think that the displays. First of all, let me say it's always a bit awkward for somebody that's responsible for the European Banking Authority to talk about non-banks. But having said that, I think that there's agreement at the global level that we need to discover how that sector works. That we need to find out more information about what are the potential linkages, the potential vulnerabilities, the potential areas that there may be stress. For us at the EBA, one particular area of concern is that it may be in the non-bank sector, those risks, but then in moments of tension, they may materialize in the banks, which is something that happened during the global financial crisis, and that's an area of concern. So I think that part of the discovery, I think is important. And if we need to have regulation to facilitate that discovery, that's fine. But I think that's the first step. We need to address that. For instance, the Bank of England is doing a stress test of the financial sector to try to identify not on institutions, but on markets and links of the financial sector where stress may be building beyond banks. So that's good. In the banking sector in particular, as Joe was saying, I think that the key message for the next 5 years that I've been hearing from FISMA is implementation. And I share that view. I mean, obviously, we have our big roadmap at the EBA, so I think implementation should probably be the priority. Okay.
So let's talk about the state of play and where we are right now on banking union. Obviously, in the last couple of months before the European elections, we saw progress on CMDI, on EDIS. At the same time, they've also been very controversial. The Commission hasn't made a secret of the fact that it's not happy with the way the CMDI negotiations are looking. Supervisors and governments seem to take different positions on EDIS depending on the country. The Council and the Parliament are divided, with the Council frozen on EDIS and the Parliament trying to move forward possibly. Where do you think this can all go? I mean, what would you like to see from CMDI and EDIS?
I think, indeed, as I said, we need to have it for the completion of the banking union and to have that comprehensive view, not looking at one particular piece of legislation. I think, I know there was a debate on CDMI. I think what was in the initial proposals, and that at least we should not forget what the objective was, and I think there was broad agreement on the objective, so let's keep that on board. I think for finalizing the banking union, apart from, as said, we need that global picture, we need also to look how we can embark on new ideas. In the past, there was the idea, for example, in the cross-border banking on have, for example, credible support mechanism. Has that been discussed and has that been thought through completely? I'm not sure. Should we not reflect on it, on mechanism of support that can also withstand in crisis situations? So I think there should be some new ideas that emerge and that should be tested. The 28 regime. Why not? It's maybe more obvious in the context of CMU, but I don't think it's excluded for the banking union as well. Are there conditions? Is there a governance that can be developed around these type of ideas? And there are other ideas. I think, why is benchification not picking up in Europe? I think we should at least raise that question. Andrea and Ria raised that question already some years ago. Is it because hosts are life of some banks miserable? I'm not sure. Is it because homes are not allowing that subsidiaries are converted? Questions I think that need to be fueled into the debate on the banking union.
And I think some of the authorities in the EU have been quite open about the fact that having gaps in the legislation makes their life more difficult. Particularly the SRB has been relatively outspoken about this. You know, Jose Manuel, does it make your life more difficult to have an incomplete banking union? Do we need to see progress on CMDI and EDIS?
My life, it makes it more difficult. Maybe I don't know, it keeps me employed, so I don't know if it makes it more difficult or easier. But I think it's important. It makes my life more frustrating because it's a goal that I think we should be achieving, and we're not achieving as quick as I'd like it to be achieved. You know, I think that sometimes I feel like we've made a large number of progress, but we continue with the debates that we had in 2010, 2011. And that we need to help authorities and citizens to understand that we've moved beyond those debates. I'll give you an example. In EDIS, you know, in 2010, 2011, we did not have basically privately funded ex-ante deposit guarantee schemes in almost any country. And most of the deposit guarantees were coming out of the budget of the governments. Well, now we do have, you know, privately funded, pre-funded already deposit guarantee funds in every member state. So that's one barrier that we have. In 2010, we did not have MREL, we did not have TLAC. We had a third of the level of capital, of core capital that the banks have now. So all those safeguards have been built. So the likelihood that there will be on the hook a national budget is much, much smaller than before. On top of that, for largest banks, we have the Single Resolution Fund, which is under a single supervision. First, they're under a single supervision, a Single Resolution Board, and a Single Resolution Fund. Hopefully we'll have also an ESM that's a backstop to that, which we don't have yet. So all those things have been built. So I think we can be relatively comfortable that some of the issues that were in the past are not likely to come back. New issues may arise, but those are not likely to come back. So we should not be fighting the war that we already won or lost. We should be preparing for the new war. And I think that's part that I hope we can convince. You know, at the end of the day, we need to be able to make sure that a resolution of a bank, small or large, is a technical issue that's being resolved by an agency, be it the Single Resolution Board or the domestic liquidation agency if it's a small bank. And it's not a major issue of policy debate in any society in which that's been involved. That's what we need to achieve.
And we've seen some, let's say, novel ideas in the new geopolitical situation on how some of these banking union tools could be used. A particularly colourful one is the idea that the ESM could be used as a credit line to fund defence. As regulators, what do you think about this?
Yes, I mean, it's fine for me. The ESM is not a bank. It's a fund. If the government wants to use it to fund defense rather than to fund, you know, structural programs of member countries, that's a decision that they can take. I'll be fine with that.
But you cannot use anymore these funds for other things.
Okay. So let's look forward a little bit to the future risks that we might see in the banking sector. I mean, we've talked broadly in the past about climate risk, digital risks. We've seen these play into the situation in the US with SVB and Credit Suisse here in Europe last year. In your view, I'd like you both to just explain a little bit. Where do you think the main risks for the banking sector are coming from now?
Yes, as you mentioned, ICT risks and cyber threats and so more globally, the idea of operational resilience is indeed, I think, top priority for, if not most, if not all, supervisors. And we see, of course, because it has such a potential, a tremendous impact on the economy it can have, and also that we see that not all institutions are very well prepared on these, that they lack knowledge, tools to these issues. In that respect, I think we could be pleased that in Europe we have Dora, and I would congratulate José Manuel and his teams and all the ESAs for the work that they have done in a very short period to address and to prepare the legislative package. Not all has been endorsed all yet already, so I think that should be done at short notice, because early next year this package will be entering into force. But I think what has been done is important preparatory work with a lot of stakeholders, with a lot of complexity, but I think the overall quality is extremely good. The challenge will be the supervision of that, to develop the supervisory framework. It's new for the ESAs, it's new for the NCAs. You need to build a supervisory framework, you need to build interaction with parties that are not always used to that kind of supervision. So that will be clearly a challenge both for the ESAs and the NCAs, but at least in Europe we have now a robust framework to attack what I consider one of the major risks of the financial sector currently.
So I'm going to add an extra question onto your comments. Biggest risks for the banking sector in general, but also we've obviously seen the CrowdStrike tech outage this year, sorry, it's been a long day, this year, and there were comments at the time, an interlinkage with Dora, and saying, once Dora is in force, could Dora prevent a future outage like CrowdStrike? I mean, what's the intersection between those two issues, do you think?
Well, if I may, Dora, I mean, the CrowdStrike is just one materialization of operational risk and resilience, which Dora is supposed to help address. Hopefully, it depends where it materializes. That one was specific on one provider, so maybe it's more likely that Dora will be addressing that. But there are other areas of operational risk that may be arising, and that's very high on our risk. If I may add, I would put a bigger umbrella with geopolitical risks, particularly in the short term, are very much underlying. And within that, you can think about cyber attacks as being one part within the digital agenda that may materialize, and it's a big area of concern. Cyber crime more broadly has been increasing too, so it's not just operational risk, but cyber crime and the cyber attacks that are important that are featuring that. As we go forward, I think that technology, digitalization offers risks and opportunities. Geopolitical, I think, is mainly risks than not many opportunities, many risks. Climate, I think, is mainly risks. It offers the opportunity of becoming good at managing that risk as we go forward, and that will be a competitive advantage, but in the short term, we need to build for that. Technology, digitalization is really opportunities and risks, so we need to make sure that we assess those properly.
And do you think we need more work on cyber risk beyond Dora? I mean, I know that SRB has talked about working on looking into the risks of digital bank runs, like we saw with the US mini-banking crisis, where everybody can physically take their money out of a bank so quickly that in itself is a risk.
When you say we need more work, I would say yes, but I'm not sure what you mean. Do we need more regulation? And that I'll be a bit more reluctant, because, for instance, when we talk about the SBB story and the lessons learned from there, from the lessons learned from the Fed, the US authorities, from the Basel Committee, they sort of came forward and said, well, there were like governance problems. That's one first layer of problem. There was supervisory intensity issues that should be addressed. Third, there was regulatory issues on scope that already Joe mentioned before when discussing Basel, that some of these large banks were not under the Basel conditions. And there may be additional regulatory adjustments that may be needed as we see digitalization increasing. But I would put that in that order of priority. I think that digitalization is changing the way in which we do business. We need to monitor, we need to understand it, we need to assess it. But I would not jump immediately into any regulation.
Okay, well.
on this. And that
Final closing thoughts, yeah.
You know, I agree fully. And some of these risks that you mentioned are very traditional risks. That is risk related to liquidity, for example, and is the framework set in place by the Basel Committee still appropriate given the new technological developments? I think, as José Manuel said, this is being discussed at the Basel table, but I would also plead not to jump to conclusions too early, but have a closer look at it and analyzing further what is the potential impact of digitalization and technological developments on the classic bank regulation like interest rate risk or liquidity risk.
Thank you so much both for joining me and for your thoughts. Let's have a round of applause for our participants. And I'm going to ask you again to stay seated as the next session is going to take place after a quick stage change. Our European economy reporter, Carlo Martuscelli, will be moderating a panel discussion on this very topic, cloud and digital finance, in a few minutes. So thank you very much.